Hello everybody, Drew Beyer here with another episode of Moving to Sarasota. We're talking money again. I've got Jake Kearney back with us, mortgage loan officer with Bell Bank Mortgage. Today we are going to talk a little bit about second homes, whether it's vacation homes, investment property, etc. I know when I talk with some of you guys, it's always kind of a different motivation depending on the person. Some people are looking to become like snowbirds, come down here, just have the second home, not rent it out. Other people want more of an aggressive investment property, maybe that makes them a little bit of money, pays for itself, knocks down that mortgage and gives them, say, a free vacation a month out of the year, something like that. So we're going to talk all that stuff and more coming right up. All right, so I'm going to pretty much just hand it over to Jake for this episode. We'll go back and forth a little bit, but like I said, most of it is on the lending side for this one. Just depends on kind of what the different properties that someone might want. So from your standpoint, from the lender, what kind of are the differences that people might run into?
Yeah, so basically when we have the initial conversation and we have to know what the consumer plans on doing with the home. Is it going to be their primary residence? Or are they going to use it for a true second home and have no intention of renting it? And then the third category would be non-owner occupied or second home, which is considered basically rentals in most people's terms.
Yep.
Are they going to rent it some throughout the year? And it affects underwriting and it affects interest rates. And the theory behind it is if somebody were to get in trouble and you own the house that you live in, you have a condo at the beach that you use for just your family, and then you have a rental property and you can't make one of those payments, which ones are you going to make?
What's the order of the
That's
shopping
correct.
cart?
So all it is basically risk perspective from the lender, because at the end of the day, history shows us that the rental property gets paid last.
Right.
So if you were going to come live in the house, obviously we're going to offer you a lower interest rate and a minimal down payment, because that's where the stability is going to be.
Right.
If somebody's going to purchase a property as a second home, they're going to require a little bit more down payment, 10% minimum, and the interest rate's going to be the same as your primary residence. If somebody's going to be renting the property, then that's when kind of the rules change a little bit, and your interest rate's going to be higher to offset that risk for the lender. It's not going to be, massively higher, but there is a difference in interest rate.
Sure.
And the most important thing that you have to be prepared for is it's going to take a larger down payment. You can do it with a minimum of 15% down, but you're going to be paying an even higher interest rate and some mortgage insurance. When you put 20% down, that eliminates that mortgage insurance, your interest rate gets better.
Right.
And right now in the current market, if you put 25% down on that rental property, your interest rate is going to get substantially larger and stuff like that.
Gotcha.
So from a qualifying standpoint on the rental property, it's not very difficult right now. One of the things that we're going to do is, even if there's no rental history for this property, we're going to have the appraiser basically prepare a schedule telling us what fair market rent should be on that property. And so we're able to use some of that to help a borrower get qualified, if that makes sense.
It does make sense, yeah.
So if they've got the down payment, a lot of times the qualifying is really not the obstacle. The down payment is the obstacle, because a lot of times the property can qualify itself, if that makes sense.
Sure.
If somebody wants to be a true investor and get a long-term tenant in there and stuff like that, it's not near the obstacle that people envision to get started, other than the increased down payment.
Right. So now let me ask you this: in our market here in Sarasota, Siesta Key, Longboat Key, Anna Maria, even moving south into the Venice area towards
Right.
the beach, we're obviously seeing a lot more vacation rentals, seasonal rentals. There's obviously annual rentals, but does that have any impact from a lender's perspective? If someone's going to rent it out annually, it's more steady, whereas a seasonal or vacation rental is obviously a higher dollar that they could potentially return, but it's not going to be that potentially steady flow.
Yeah, and that's always been a gray area because from an underwriting perspective, Fannie Mae and Freddie Mac doesn't have a different category for vacation rentals versus long-term rentals.
Gotcha.
It's just basically rentals and non-rentals, right?
Right.
So it's a little bit of gray area on our side. So we're going to be relying on the appraiser on that, and the appraiser is going to give us that number. If the appraiser determines that the average fair market rent for that home is $2,000 a month, and are we going to investigate or have a discussion with him on, is that going to be $2,000 a month average from a vacation rentals or a long-term lease?
Gotcha.
That's that might be an interesting question to have with an appraiser and stuff like that, but I've never seen that differentiated.
Okay.
They say that on average this is going to do X amount.
Gotcha.
So
Cool. All right, so then one last point is condo, especially for this area, which is very popular, condos, condotels, just all kind of multifamily, vacation, resort style, whatever you want to call it, that kind of financing. What's that look like compared to a single family home or compared to...
Property type can be an issue and affect how we do financing. So when you buy a condo, it's a little bit more in depth than buying a single family home because as lenders, we send questionnaires to the condo association.
Right.
And the way to think about it is in addition to approving you as a buyer, we have to approve the condominium. And what I mean by that is we contact the HOA management company. They fill out this detailed questionnaire. It's telling us information such as, and it's the information that you want to know as a borrower too, to make an educated decision.
Yep.
What percentage of the units are rentals? What percentage of them are second homes? We verify the insurance that's in place on the condominiums to make sure that the homeowner, our borrower, and then our collateral is also protected.
Right.
If it's in a flood zone, we're verifying that they have flood insurance. We're verifying that they have insurance for theft of the association funds, which is your money.
Right. And all of these things, like you mentioned, different types of insurance, and depending on the association, these fees, you're paying for all this stuff. So it could be $200 a month, but more than likely with a condo here in Sarasota, it's going to be $500, $600, $700 plus per month. You never know what, depends on the association and what amenities you're getting along with, the different insurances and stuff.
One of the things that's also very important is we're investigating from a casual level, but they have to disclose whether there's any lawsuits against the HOA.
Yep.
And you want to know that also, if you're going to be a member of that HOA, is there going to be enough insurance to cover if the HOA is found to be at fault, or would there be a potential for a special assessment?
Right.
And as lenders, we don't want to put anybody in that position.
No.
And so we make sure that, we know it and you know it. There are some projects that you see in resort areas that you cannot get traditional financing on. That's typically going to be called a condotel. And what they mean by that, it's a hybrid between a hotel and a condominium.
Right.
Primarily, it's going to have a lot of commercial area, or they market it as kind of more of a daily rentals, or it's a lot of times you can tell simply by the way that it's marketed, whether it's a traditional condominium or we're going to have more difficulty from a financing perspective from a condotel. So
condotel, definitely from my experience, it kind of throws a little curveball in there with the
financing. Financing is going to be significantly more limited as far as when it comes to options, and anytime that's it's more limited, traditionally the costs are going to be a little bit more expensive and stuff like that, and it's going to take a little bit longer. There are outlets out there that will finance units, but it's certainly not everybody. So, for example, I can't finance a condo hotel.
Gotcha.
A lot of banks stay away from that type of financing, and so you have to look elsewhere.
More local lenders, smaller.
It's available, but you just have to be prepared for it and stuff like that. So.
Gotcha. Okay. Cool.
Yeah.
All right, guys, so that will wrap it up. I hope that kind of gave you some more perspective on investment properties and, condos, to just overall kind of the differences between primary and secondary homes, and what the lending looks like on those. If you have any questions, definitely hit up Jake or myself for both, lending and real estate questions. Our information will be in the description below and also on the screen. you have a chance, please do like and subscribe. Would really help me out and the YouTube algorithm. So other than that, we will see you in the next video. And you see on the screen right here, both of our contact info is up. So if you have any lending questions, thinking about coming down here, definitely reach out to Jake. It'll all be in the description below as well. Shoot him an email, text, call, whatever works. And other than that, I want to thank you guys for tuning in. Go ahead and click the like and subscribe buttons if you get a chance. Would really appreciate it. Helps out with the algorithm. Also, down in that description below, there is the link to our Facebook group, Moving to Sarasota Bradenton area. Still just exploding with growth, which is great to see. And other than that, we will see you guys in the next video.